Welcome to Federal Tax Exemption and Nonprofits, a primer for the nonprofit attorney, sponsored by the American Bar Association. If you are seeking CLE credit, you must attend the entire program. Partial credit is not available. Please click on all participation verification alerts during the program to confirm your attendance. Immediately after the program ends, a link to complete the certification process will appear. Please complete the evaluation and the CLE affidavit, providing your bar information as requested. Once the completed form is submitted and your attendance verified, your certificate will be emailed to you. Presenting our program today, we have Jeffrey Tenenbaum, who is one of the nation's leading nonprofit attorneys, an accomplished author, lecturer, and commentator on nonprofit legal matters. As managing partner of the nationalized, recognized Washington, D.C.-based Tenenbaum Law Group, PLLC, Jeff counsels his clients on the broad array of legal issues affecting charities, trade and professional associations, foundations, international NGOs, arts and cultural institutions, think tanks, and other nonprofit organizations, and regularly represents clients before Congress, federal and state regulatory agencies, and in connection with governmental and internal investigations, enforcement actions, litigation, and in dealing with the media. Jeff, you may proceed with the program.
Thank you very much, and good afternoon to everyone. Welcome to our webinar today, Federal Tax Exemption and Nonprofits, a primer for the nonprofit attorney. So I have been practicing law in Washington, D.C. in private practice for my whole 26-year career, all of it, as you heard in the introduction, representing all different types of nonprofit organizations, primarily as outside counsel. And yes, there is a field for attorney practice involving the representation of nonprofits. The nonprofit bar is not as big of a bar as other bars across the country and represented by the ABA, but it is a bar in and of itself. And in fact, the American Bar Association has two committees, one in the business law section and one in the tax section, kind of devoted to nonprofit organizations. I'm a member of the Nonprofit Organizations Committee in the ABA's Business Law section, and I chair the Trade and Professional Association Subcommittee. And then within the tax section, there's a Tax Exempt Organizations Committee that focuses primarily on the tax issues, whereas the Nonprofit Committee is a kind of a broader reach. But nonetheless, while my practice covers a very broad array of legal issues affecting nonprofits, today's webinar is going to be focused on tax exemption issues and a little bit in the beginning on kind of nonprofit corporate issues, frankly, because there's just so much confusion. If you asked, I'd say 9 out of 10 people in the country, lawyers and non-lawyers alike, who don't practice in this area, and what's the difference between a nonprofit and a tax-exempt organization, most would not be able to tell you. It's probably even a higher percentage than that. This is not intuitive stuff. There's a lot of nuance and complexity here, yet it's critically important, because while nonprofit organizations face many of the same legal issues that for-profits do when it comes to employment and intellectual property, copyrights, trademarks, employment issues, contracts, and the like, there's this whole set of kind of nonprofit corporate law and federal tax exemption law that underlies everything that nonprofits do and puts all sorts of restrictions and prohibitions and limitations on what they can do. So it's critically important to understand that. The idea behind this webinar was that many lawyers, like presumably many of you who are on the call today, and this is very common, and I was at a large firm for 19 years, the Venable Law Firm in DC, and there were many lawyers across the firm who kind of had 1 or 2 or 3 nonprofit organization clients. I chaired the nonprofit organization's practice there, but I saw, how common it was. Someone has a relative or a friend or some sort of connection. Maybe they serve on the board, maybe they do some pro bono work, maybe they just ask questions once in a while. And maybe you have some clients who are nonprofits, but you don't have deep expertise in the area and it's not your primary focus. That's what this webinar is all about. I'm going to try to make this stuff as simple and easy to understand as possible. And just so you know about my current practice, 22 months ago, I started Tenenbaum Law Group with another lawyer. We've since added a third lawyer, and we're searching for a fourth. We've been rapidly growing, and we're a boutique focused exclusively on the representation of nonprofit organizations, primarily as outside general counsel. So all of these issues that we're going to talk about here today are informed by 26 years of working with literally thousands of different nonprofit organizations in every aspect, including in connection with many IRS audits and appeals of nonprofit organizations. Probably dealt with close to 100 when I was at Venable. And that experience kind of deeply informs a lot of the things we're going to be talking about here today, and hopefully you'll find it helpful. As you heard from Shalane, please do pose questions throughout and or at the end, and we'll get to as many of those as we can. So first thing, as I alluded to, what's the difference between nonprofit and tax-exempt status? Most people don't understand the difference. Many people misuse the terms, and it's a critical distinction. So there's as the slide says, there's a notable difference between a nonprofit's nonprofit corporate status and its federal tax-exempt status. So the nonprofit corporate status, whenever you incorporate a corporation, there are lots of different types of corporations, as you probably know. You know, there's traditional kind of C corps, there's LLCs, but then there are nonprofit corporations. The principal distinction between a nonprofit and a for-profit corporation is that a nonprofit corporation has no owners. No one owns a nonprofit. The name is a misnomer because nonprofits can earn as much profits as they want. There's no limitation on profits. I had a new client ask one of my colleagues, or tell one of my colleagues today, that the organization that he wants to form, it should qualify as a tax-exempt organization because it's not going to make money. And as she explained to him, that's irrelevant to the analysis. It has nothing to do. You can make money. You just have to make money from activities that are in furtherance of your mission and purpose, and then the profits have to be reinvested back in the organization in furtherance of its mission and purpose. So a nonprofit corporation has no owners. But when you, I should also state, this is important for this organization, for the ABA, that all states and DC have their own version of a Nonprofit Corporation Act statute. Most of them are based largely on the American Bar Association's Model Nonprofit Corporation Act. And I am excited to say that at our last Nonprofit Organizations Committee for the ABA, which was about a week and a half or 2 weeks ago, the committee approved the fourth edition of the Model Nonprofit Corporation Act, which will soon be released. And there's a terrific subcommittee within the committee that does really hard work and really does a great job of continuing to refine it. And hopefully many of the states will adopt a number of those changes. So when you incorporate, it has nothing to do with tax status. So by default, if you incorporate a nonprofit corporation and you do nothing else, you are going to be a taxable nonprofit. Actually just came back today, I got back from a client board meeting where the board approved the creation of a new structure where there's going to be what I call a taxable nonprofit corporation. Sometimes there are reasons why you want an entity to be a nonprofit corporation but don't want it to be tax exempt. That's not the norm, but sometimes some of the limitations and prohibitions and restrictions that come along with tax exempt status are not desirable or workable within the business model. But you also maybe don't want to have a for-profit corporation because you don't want to have owners, and that can create problems. So there is such a thing as a taxable nonprofit corporation, and you do that simply by incorporating as a nonprofit. You're still subject to the State Nonprofit Corporation Act of where you incorporate, but you just don't go ahead and file the application with the IRS to seek recognition of your tax-exempt status. Very rare, but sometimes important and helpful in certain situations. That being said, most nonprofits, after they incorporate as a nonprofit and they get their EIN number and they draft bylaws and governance policies and things like that, and then they prepare an IRS application for recognition of tax-exempt status. Once you do that, and there's all different categories, about 30 plus categories of federal tax exemption, most fall into section 501c3, 501c4, or 501c6, or at least most of the ones that I deal with and that I see the most. There are lots of other categories as well. There's like 501c19 veteran organizations, there's 501c7 social clubs, there's 501c5 labor unions and agricultural organizations, and there are certainly others. But for most of them, you apply to the IRS by filing either the IRS Form 1023 for would-be 501c3 organizations, or the IRS Form 1024 for like C4s and C6 organizations. We're going to talk a lot more about that. Once you file with the IRS, once the IRS approves the application, it's retroactive back to the date of incorporation, and then you are a nonprofit and a tax-exempt organization. And I'll talk about what it means to be a tax-exempt organization. In fact, that's going to be the focus of most of today's discussion. So these state nonprofit corporation statutes, most of which, not all of which, and they're not all created equal, by the way. So if you're ever thinking about forming a nonprofit, don't think you need to form in the state in which the entity will be located. In fact, it's extremely common. Of all of our 450 plus clients, I would guess at least half of them, if not more, are incorporated in one state, but their headquarters is now in another. They often incorporate in a state where they got started. It could be 50 years ago or more, but then they move somewhere else. That's perfectly okay, not a problem at all. You just have to what's called qualify to do business as a foreign corporation in the state in which your headquarters is and where you have any offices or employees. But for purposes of all the things that are regulated by the nonprofit corporation statute, what matters is your state of incorporation. So even though you might, be incorporated in DC and then your headquarters moves to New York, you're not governed by the New York Not-for-Profit General Corporation Statute. You're governed by the DC Nonprofit Corporation Act. These state statutes regulate a wide array of governance, operations, and activities, including things that the organization must do and things that it cannot do. Some of them relate to things like conflict of interest and private endearment and private benefit. A lot relate to governance matters, like election and removal of board members and officers and bylaws, amendment of bylaws and mergers and amendment of articles of incorporation, all of those sorts of things, whether you have members or non-members, all of that is relevant. And that is, by the way, an important distinction. So when you form a nonprofit corporation, in at least in every state that I've seen the statute, which is most of them, you have to indicate in the articles of incorporation whether you have members or not. And what that means is voting members. You don't have to have members. So for instance, most charities and foundations that are exempt under 501c3 don't have members, although some do. Whereas most 501c6 organizations, which is the category reserved for trade and professional organizations, an area in which I do a lot of work, those organizations generally do have members. And that makes a big difference because whether you have members or not affects what sort of rights each of the bodies have, the board of directors versus the members within the nonprofit corporation. So make sure you think that through carefully. And sometimes we utilize the member tool as a way for one nonprofit to control another. So because nonprofits have no owners, you can't have one nonprofit own another. So say one nonprofit, say it's very common, a 501c6 trade or professional association wants to create a 501c3 related foundation. But it wants to make sure it has enough control over it so it doesn't just, it's going to put, invest money in it, perhaps transfer some intellectual property, do whatever else. It's going to, really try to pump it up and grow it. It doesn't want it to run away on its own, so it wants to maintain certain levels of control. One of the best ways to do that is to create a membership, make the C3 a membership organization, but make, say, the C6 in that example the sole member, or it could be a 501c4 or whatever the category is. I often generally refer to that as a controlled affiliate. It's not a subsidiary is technically reserved for ownership. There's no ownership there. It's a controlled affiliate. But using the membership model is a great way to maximize control. There's other ways to do it too, through a contract, like an affiliation agreement, through the governing documents like the articles of incorporation and the bylaws. I like to kind of do a belt and suspenders approach to really put some golden handcuffs on the controlled affiliate, and creating a membership corporation is a great way to do that. You can also have for-profit subsidiaries of nonprofits, what I'm going to refer to in a bit as a taxable subsidiary, and I'll talk about those a little bit later. The state nonprofit corporation statutes also have certain default provisions in the event that certain matters are not addressed in the articles or bylaws. So say, for instance, the bylaws don't specify what a quorum is for purposes of board meetings. The statute, most of the statutes will say that if it's not otherwise indicated in the bylaws, a quorum is a majority of all directors / board members. It's the same thing. So if I refer to directors or board members, they're one and the same. And that's important. I mean, typically, most nonprofit boards of directors have at 51% of the board. But when it comes to membership votes, like for a trade association, the default provision will often be a majority of all members, whereas in most trade associations and professional associations, a majority is really hard to get for a membership meeting or a membership vote. So you want to be sure to affirmatively specify in the bylaws that the quorum is, say, 25% or whatever the number is going to be. And I'm just using this as an example, the quorum issue. The statutes will often say that the bylaws can set whatever quorum you want for membership meetings and membership votes, except it can't go below 10%. Or something like that. That's kind of a common provision. Again, every state statute's a little bit different. But I want you to have a bit of an understanding as to how these statutes work. Most of them are fairly easy to read, but like all statutes, they can be tricky because if you read one provision in isolation without knowing how it relates to another provision, you can sometimes get the wrong answer or the misinterpretation. Anyway, so a nonprofit corporation's internal governance rules, like its bylaws and its policies, have to be consistent with what's in the statute for the state of incorporation. So another example, most, not all, but most state nonprofit corporation statutes say that board members are not allowed to vote by proxy. The idea being that board members owe a fiduciary duty to the organization. They can't delegate that to somebody else, so you can't send a proxy to the meeting, to kind of vote and act on your behalf. Whereas, by the way, most of the statutes, all of the statutes, I think, do say that members can vote by proxy or send a proxy to a meeting, but not board members. So if you had a provision in your nonprofit's bylaws that said board members can vote by proxy, but that's not consistent with the state statute, then that provision would be null and void. So one of the things that we do when we review nonprofit bylaws, which we do probably every week, is, among other things, we're looking to be sure that what's in the bylaws is consistent with what's in the state nonprofit corporation statute, as well as what's in the articles of incorporation. And as you see in that slide, there's this hierarchy with the statute at the top, then the articles of incorporation, then the bylaws, and then any board adopted policies, which are common. And each one has to be consistent with what's above it, because what's above it kind of trumps it. So, you can't have something in a policy that's inconsistent with what's in your bylaws. You can flesh it out, something in the bylaws. You can, for instance, extremely common, and in fact, you almost never don't see it, to have like a board adopted conflict of interest policy. And you're not going to typically you don't want to put the conflict of interest policy in the bylaws itself. But if there are any provisions in the bylaws about conflicts of interest, the board adopted conflict of interest policy has to be consistent with the bylaws. And then, of course, with the articles and then with the state nonprofit corporation statute. Okay. So that's what I'm going to cover on nonprofit corporation statutes. I could talk actually all day on these kind of corporate governance issues. We deal with them all of the time. All sorts of issues arise in terms of board meetings and votes and conflicts of interest and membership actions and all sorts of other things. I just wanted to flag for you so you get the basic construct of how this all works. And that's really the purpose of today's webinar generally. So we're going to move on to federal tax exemption. Like I said, the vast majority of all nonprofits that form as nonprofit corporations then go to the IRS to seek recognition of their federal tax exempt status from the IRS under one of the various categories of tax exemption. And that's important to note. A lot of people use the wrong verbiage. They refer to asking the IRS to grant tax exempt status. And that's not the way the statutory scheme works that Congress wrote. It's rather that you have to establish that you're both organized, like your formation documents, and operating consistent with the rules, say for 501c3 status. Then the IRS looks at all of that, evaluates it, and recognizes you as a 501c3 organization. They're not granting the C3 status. There are, of all of the, I think there are about 2 million tax-exempt organizations that have not been revoked on the IRS kind of tax exemption rolls. The vast majority of those are exempt under 501c3. Most charities, foundations, schools, religious institutions, nonprofit hospitals, arts and cultural institutions, international NGOs, they're virtually all exempt under 501c3. I will talk in a little bit about there's kind of a subclassification of C3s between public charities and private foundations. They're all C3s, but there's a subclassification. I'll talk about that in a bit. C3s have the most benefits in terms of it's the most beneficial status. There's the most benefits to being a 501c3, but because of that, there's the most material limitations and prohibitions that are imposed on C3s, and I'll talk in a bit about what all those are. There other nonprofit corporations are exempt under other categories. I referred to C6 trade and professional associations and chambers of commerce. 501c4 social welfare organizations, and by the way, I'm going to get into a discussion in a bit about 501c6s. Most of what I'm going to talk about there is equally applicable to C4s, with the exception of the membership part. The rest of it, all of the basic limitations and allowances, for lobbying and political campaign activity and things like that, from a tax code perspective, they're exactly the same for C6s and C4s, so keep that in mind. And C4s have become increasingly common, particularly after the U.S. Supreme Court's decision a number of years ago called Citizens United. Kind of that opened the door to a lot of political activity where you didn't have to disclose donors, and a lot of that gets done through 501c4 organizations. So they are increasingly common. You also have 501c5 labor unions and agricultural organizations, C7 social clubs, and a number of other categories. Like I said before, the form you file for would-be C3s is the Form 1023 application, and for most other categories, it's the Form 1024. And for a would-be private foundation, there's a separate form that's utilized for that, and a separate schedule as well. Here we go. Okay, so after you get your tax-exempt status recognized by the IRS, there's also a requirement to file an annual return with the IRS each year. It's not a tax return because you're not paying taxes. It's called an information return. And it's referred to generally as the Form 990, but there are actually four different versions of it. The Form 990, the Form 990EZ, and the Form 990N are three different versions, kind of going down in complexity. So the 990 is the most robust form. The 990EZ is a much simpler form, and then you get the 990N for really small organizations. So it's depending on the size of the organization, revenues and assets and whatnot. You have to file that form in the IRS each year. If you fail to file 3 years in a row, as the bottom bullet point says, and this is a law that Congress passed maybe a decade ago or a little more, you automatically lose your tax-exempt status if you fail to file 3 years in a row. So it's really important. Then the Form 990PF is the form used for private foundations. There is one form of a tax return that some tax-exempt organizations have to file with the IRS. That's called the Form 990T. That's if you earn unrelated business income and are subject to unrelated business income tax. And I will talk a lot shortly about unrelated business income. And I just wanted to flag that Form 990T is what you use if you have taxable unrelated business income. Tax-exempt organizations can earn and pay federal and state corporate income tax on unrelated business income, what I call UBI here. You'll sometimes hear the phrase UBIT, UBIT. That's the unrelated business income tax. That's the tax you're paying on the income. Just like for-profit taxable corporations, you pay tax on the net income, less any directly connected expenses, and you have to pay it at both the federal and state level. And then back to the 990, when you get recognition of your federal tax-exempt status, and keep in mind, this is different from what I said earlier about your state of incorporation and being governed by your state of incorporation's nonprofit corporation statute. When it comes to the 990 and federal tax exemption, here it's based on where your headquarters is, where your current headquarters is. So if your current headquarters is, say, in DC, where I am, then once you get your IRS federal tax exempt status recognized, you have to file a copy of that determination letter, it's called, that you get from the IRS with DC. It's basically an automatic recognition of your DC corporate income tax exemption, or in any other state, your state corporate income tax exemption. But it's very important that you do so. It's virtually automatic process, but you have to file in order to get there. And then on an annual basis, most states and DC require that once you file your 990 with the IRS, you also file a copy of it with the state or DC. All right, now we're going to get into some of the kind of limitations, restrictions, prohibitions on tax-exempt organizations. So this one is the private inurement doctrine. It's applicable to most categories of tax-exempt organizations, including C4s, C3s, C6s. In contrast, there's something called the private benefit doctrine, which I'll talk about in a minute. That is only applicable to C3s and C4s. So the private inurement doctrine basically prohibits paying excessive compensation, which is defined as greater than fair market value, to those with an ability to exercise substantial influence over the organization, such as officers, directors, key employees, and sometimes others, such as founders. All tax-exempt entities can lose their tax-exempt status for private inurement, but only 501c3s and C4s are subject to these penalty taxes that are referred to as intermediate sanctions. They're basically excise taxes under Code Section 4958 that can be imposed by the IRS on that excessive compensation, both on the recipients of that compensation and those who approved it on an individual basis. What is going on with this slide in the funky font and size, but hopefully you can read it. So under the intermediate sanctions rules, excise taxes can be imposed on any excess benefit transaction. And that's any transaction in which a C3 or C4 organization provides an economic benefit to a disqualified person. That's basically the fancy term for anyone that can exercise substantial influence over the organization, that has greater value than what the organization receives from that person. So for instance, if the CEO gets paid greater than fair market value compensation, the CEO or executive director is certainly going to be considered a disqualified person, then that could be subject to intermediate sanctions if it's a C3 or C4 organization. So like I said in the second bullet point, this could be providing compensation to a person in excess of the value of the services rendered, or selling or renting property to a person for less than that property's sale or rental value. And the excess benefit is the difference between the value of the benefit provided to the person over the value of the consideration received by the organization. So whatever, let's say, the IRS comes in and they audit the organization, and they do their own compensation analysis, and they determine that, the maximum fair market compensation for that, nonprofit CEO is $200,000, and the CEO got paid $300,000 in that given tax year. Well, the delta there, that $100,000 would be the excess amount. That would be the excess benefit amount, and that's the part that's subject to these excise taxes. So there's two types of excise taxes here. The first tax is imposed on the disqualified person who receives an excess benefit. It's equal to 25% of the excess benefit. So if, let's say in that example, $100,000 was the excess benefit, the tax would be 25% of that, which would be $25,000, and the individual has to pay back that excess amount to the organization. And if they do that right away, then they pay back the $100,000 and they pay a 25,000 penalty to the IRS under intermediate sanctions, and that would be done. If they don't do that very shortly, or by the date that the IRS issues a deficiency notice on that 25% tax, then there's an additional tax equal to 200% of the benefit amount. So that's one of the taxes. That's imposed on the recipient of the excess benefit, the excess compensation or whatever it is. The second tax can be imposed on what are called organizational managers. This could be board members, it could be an executive committee, a compensation committee, those who knowingly, willfully, and without reasonable cause participate, for instance, approve the excess benefit transaction. And that amount is equal to 10% of the excess benefit, but cannot be more than $20,000. So that can get people's attention, board members and others who are approving compensation. A disqualified person is defined as someone who, during the 5-year period preceding an excess benefit transaction, was in a position to exercise substantial influence over the organization. Now there is, and this is really important, and if you've been involved in nonprofit compensation setting at all, you've probably seen this, or maybe you just instinctively can. It is a fairly intuitive concept, but when Congress wrote in, I think it was in the mid-90s or so, these intermediate sanctions penalties into the tax code, and it was at the request of the IRS. They also included something called the rebuttable presumption of reasonableness. And what this rebuttable presumption of reasonableness says is that the compensation will be presumed to be reasonable if you follow 3 steps, and that will create a safe harbor. And then it's up to the IRS to rebut the reasonableness of that compensation. So if the compensation is reasonable, then there's not going to be any penalty taxes imposed. And so what's happened ever since then is that this 3-step process has become the norm and the best practice when it comes to compensation setting or anything else, like sale of a big asset or something like that. The 3 steps are: 1, the compensation should be set in reliance on appropriate comparability data. And I say appropriate because I've been involved in some IRS audits where the IRS challenges the appropriateness of the comparability data, saying the organization or the comp consultant cherry picked and chose certain comparables that really weren't relevant to kind of inflate the compensation amount. So it's got to be set in reliance on appropriate comparability data. You can do that. The best way, if you can afford it, is to hire a professional compensation consultant. And there's some phenomenal ones out there that specialize in nonprofits that I work with all the time. If you can't afford to do that, the organization can't afford to do it, maybe purchase an off-the-shelf current salary survey, compensation survey. You could do your own comparability analysis by pulling the Form 990s. These are all publicly available documents. You can get them from a number of different sources online very easily. And so if you can identify appropriate comparably sized, comparably located, comparable number of staff, revenues, things like that, you could look at 990s and do your own analysis. Second, the compensation decisions have to be made by independent decision makers with appropriate recusal by the recipients of the compensation, and then the process has to be contemporaneously documented. So that has become a best practice. The IRS even asks in the Form 990, even for 501c6s and others that are not even subject to the penalty taxes, but they ask, do you use this process in setting the compensation of key employees and others that get compensated? So if it's the CEO, it's going to be some group of volunteers, or there's the board or the executive committee or the comp committee that's doing this. If it's other staff within the organization other than the CEO, usually it's the CEO who will go through this process. And that's okay as well. But you want to make sure you follow that, or that your clients follow that process, I should say. I think some of you are in-house, and this is relevant to you, but for those of you who are in private practice, obviously this relates to your clients. Both intermediate sanction penalties and revocation of tax-exempt status are possible outcomes from excess benefit transactions, but intermediate sanctions are only applicable to C4s and C3s, as I said earlier. The IRS asked for these penalties because what they were finding is that in a lot of cases of some real abuse, the only thing they could do at the end of the audit was revoke the tax-exempt status of the organization, which is really the victim. Of some people who are really kind of just taking a lot of money out of it for their own benefit. And so that was kind of the purpose behind it. And we have seen a number of situations where the IRS, assesses intermediate sanction penalties and does not revoke the tax-exempt status of the organization, really when they feel like the organization was the victim. Both of these can only be enforced by the IRS through the audit what the IRS calls the examination process, there is no private right of action. So you can't sue an organization in order to assess these penalties. Now, the private benefit doctrine is different. It's generally only applicable to C3s. There's some unsettled law as to whether it also is applicable to C4s. But generally, it's only applicable to C3s. And what it requires is that on balance, that the 501c3 entity must confer more benefit on the public than it does on private parties, both qualitatively and quantitatively. So again, this is different from the private inurement doctrine. It's a broader doctrine. For one, it does not require disqualified persons. It doesn't have to involve people who have an ability to exercise substantial influence of the organization. It can be broader. What the doctrine requires, what it prohibits, is only impermissible private benefit, not all private benefit. If you think about it, like say a 501c3 organization is hiring a contractor, a vendor, a consultant, say, or a lawyer to perform some services. Is there some private benefit to the consultant or the lawyer who gets hired and paid by the organization? Of course. And that's okay, so long as the benefit, for instance, the reason for hiring the lawyer or the consultant is to advance the mission of the organization. Part of that might be, keeping them out of legal trouble and things like that, which certainly is going to be deemed to have a public benefit because it's something to protect the public benefits of what the organization does. So the quantitative test says that the public benefit has to outweigh the private benefit. The qualitative part of the test says that the private benefit can be no greater than necessary in order to achieve the public benefit. So both of those have to be established, and only if the private benefit is significant is it going to risk the organization's tax-exempt status. That is the only outcome here for impermissible private benefit. There are no intermediate sanctions or anything like that, and again, there's no private right of action. So this is something, it's a really difficult concept to get your arms around. But, for instance, we were talking with a client this morning who was looking to basically form a new 501c3 organization solely to provide benefits to this for-profit company that they own. That's a situation that almost certainly is not going to pass the smell test for private benefit. And if we went to the IRS and filed a Form 1023 application, it's almost certainly not going to get approved because the IRS is going to say, look, the principal benefit here is only going to this for-profit company. And even if you have completely separate boards and complete separation between the two, which is what they were proposing, still the benefit is only going to that small one company, that it's not going to the broader public. There's a concept of a charitable class. It means like the benefits of the 501c3 have to be broader than just a small group. That comes back to the private benefit doctrine. So again, I could talk all day about this. If you're ever interested in learning more about this, it's a bit dated, but the IRS has a terrific, just email me, I'll be happy to send it to you, a terrific CPE, continuing professional education article about the private benefit doctrine. The law has not changed in this area for a long, long time. But it's probably from the mid-90s or something around there. But it gives lots of examples of cases and rulings, and it really helps to explain what the private benefit doctrine is all about. So if any of this is resonating to you guys in some situations that you're involved in or whatnot, take a look at that article. I think it'll help really flesh out the doctrine more. All right. Okay. So I said this earlier with respect to UBIT, unrelated business income tax. But exemption from federal corporate income tax does not automatically confer exemption from other forms of federal, state, and local taxes. So for instance, nonprofits, tax-exempt organizations are subject to unrelated business income tax if they earn unrelated business income. I'll talk about that in a minute. They're subject to federal payroll taxes, state and local sales and use taxes, and property taxes. Now, in most states, cities, and counties, 501c3 tax exempt status is a prerequisite to getting state sales and use tax exemption and property tax exemption on real property. But there usually are additional requirements as well. Sometimes a C3 status alone is enough to qualify for sales tax exemption or property tax exemption, but usually it's a narrower definition of who qualifies in the state. It's very state, city, and county specific. By the way, the sales and use tax exemptions, when they are available, it's only an exemption on purchases. So whatever the organization might go out and purchase to carry out its mission and whatnot, or even purchases on food and beverage for events and things like that, which is very common. But it's not an exemption from collecting and remitting sales tax on sales. So to the extent the nonprofit is selling things, which is very common, there is no such thing as an exemption from collecting and remitting sales tax on sales and use tax on sales. I mean, there are some narrow exceptions, but that's not common. Now, I alluded to this earlier when we were talking about controlled affiliates. But tax-exempt organizations are permitted to have both taxable and tax-exempt subsidiaries and affiliates, both recognized as separate legal entities for federal income tax purposes. Both taxable and tax-exempt, as well as what are called disregarded entities, such as LLCs. So what are some of the most common types? Actually, I forget, my next slide covers this. Yeah, it does a bit. So subsidiaries and affiliates are used for a variety of purposes, such as being able to engage in activities that are prohibited or limited by the parent's tax-exempt status. Liability protection is a really big one, protecting the assets of one organization from the activities that might give rise to some significant liability risk of another subsidiary or affiliate. Funding opportunities, if it's you have, say, a 501c4 or C6 organization, but there's some, government, federal, state, or local government grants or private foundation grants or other grants that are limited to 501c3 organizations, which is common. Not always, but it's common. You might want to create a controlled 501c3 affiliate to be able to qualify for those funding opportunities. Sometimes for purposes, it's way beyond the scope of this presentation, but government grant and contract indirect cost rates, public charity status, again, that's a bit beyond the scope. We're getting into some complex issues, but I'm just listing all the different reasons that I have formed different subsidiaries and affiliates. Purposes of joint ventures. For instance, if you want to have a joint venture between, say a nonprofit and two for-profits or two individuals like investors, sometimes we utilize a multi-member LLC, limited liability company, to do that. There's a whole set of rules about that the IRS has, but it is possible and permissible. To enable what I just talking about, to enable multiple owners to facilitate investment and perhaps later sale of the venture. Public perception, separate IRS wanting a need to have separate IRS Form 990, so that everything doesn't show up on the same form. Sometimes wanting to have separate governance structures, like separate boards that have different skill sets and different purposes. One might be a fundraising board, and one might be a very different board of specialists in a given industry or profession. So there are lots of different important reasons. I spend a lot of time, my colleagues and I do, on this stuff. It's really fascinating stuff because you'd be surprised how many different things you can do, how many funding sources you can attract, how you can attract investment, how you can isolate liability risk by using all these different forms of taxable and tax-exempt subsidiaries and affiliates. And with an LLC, you see it in the bottom bullet point there. I talked a minute ago about multi-member LLCs, but what we also utilize for a lot of our clients, it's very common, is a single-member LLC. So a single-member LLC is just what it says. I get asked a lot, is that a for-profit or a nonprofit? And it's really not either, because, I guess in some ways, from a state corporate law perspective, it's a for-profit because it has an owner, which is the member. The member, in the case of an LLC, is the owner. So from a state law perspective, it's a for-profit in that there is an owner. But from a tax exemption perspective, if a tax exempt organization is the single member of an LLC, then that LLC is disregarded for federal income tax purposes, meaning it does not exist. So it kind of takes the form of the tax exempt organization. So all of the income and expenses and assets and liabilities of the LLC get rolled up into the tax exempt organization for purpose of Form 990 reporting and things like that. If the income coming into the LLC would be exempt to the tax exempt organization, then it's exempt coming into the LLC because they're all one and the same. But from a liability perspective, because of the state corporate status, it's a separate entity. So it's a brilliant model that's become much more common in recent years, primarily for liability protection. In fact, we have some clients that actually have, maybe 10 different single member LLCs that operate in different states or different countries, particularly different states in the US, for liability protection. Completely permissible. The LLC is a really kind of user-friendly corporate form, a lot simpler than and a lot easier to manage than traditional C Corp. And so just keep in mind, I'm not going to get into any more detail about that there are lots of different options. Other common examples, there's a lot of 501c3s that create an affiliated C4 to do advocacy and political activity that's not permitted by the C3. I'll talk about that in a minute. A lot of 501c6 trade associations that create related C3 foundations to take advantage of status that they can't get in a C6. Taxable subsidiaries, I'll talk in a few minutes about the fact that you can earn unrelated business income as a tax-exempt organization, but you can't earn too much or you risk losing your tax-exempt status. But if you have something really good going, you stumble on some great business opportunity and it's making a lot of money, it's all taxable unrelated business income, you can take that activity and just dump it into a wholly owned taxable subsidiary. And then there's no limit on how much you can earn because it operates like any other for-profit taxable subsidiary. It pays corporate income tax, which is a flat 21% now on its net income. There's some other benefits as compared to earning it through the tax-exempt organization that I'll talk about in a minute. But keep in mind that's completely permissible. And with taxable subsidiaries, while the net income is going to be subject to federal and state corporate income tax, the subsidiary, and we're talking about a C Corp, can pay after-tax profits up to the parent tax-exempt organization in the form of dividends, and all of that is tax-free to the parent on an unlimited basis. So lots of interesting opportunities there. Okay, sorry, you can probably tell I get a little more excited about some of these more complex structures after doing this for 26 years. It's the really complicated structures that really enable organizations to take advantage of a lot of things they didn't even know were possible and get into some really exciting business opportunities that help further the mission, but also protect the parent's tax-exempt status and protects them from liability risk. But now let's talk about some of the kind of the basics, requirements and limitations and prohibitions for C3s, and then I'm going to contrast it with C6s/C4s. So for C3s, this is, again, broadest category of tax exemption: educational organizations, scientific, charitable, and philanthropic, relieving the burdens of government, also religious, nonprofit healthcare, arts and cultural institutions. There's lots of different types of entities that can qualify for 501c3 status. Like the other categories, it means that your net income is exempt from federal and state corporate income tax. In terms of the benefits, one of the principal benefits, many would say the principal benefit, is that contributions to the organization are generally tax deductible by donors as charitable contributions, both by individuals and corporations. There are some limitations in total if you make a ton of charitable contributions in a year, but generally speaking, the contributions by donors are tax deductible as charitable contribution, less the value of any benefits that you get in return. So for instance, you buy a $200 ticket to a charity, annual fundraising gala, dinner. Your ticket or your receipt is generally it should say on there, thank you for your generous contribution and purchasing the ticket for $200. Please be advised that the value of the food and drink that you're going to receive at the event, fair market value is $75. So you're only eligible to take a charitable tax deduction for the difference, which is $125. And tax-exempt entities, there's been a law that's been on the books for about 20 years now that requires tax-exempt 501c3 organizations, if there's what's called a quid pro quo payment, meaning someone makes a payment and they're getting something of value in return. If the payment's over $75, then the tax-exempt entity is required to provide that receipt that puts the value of the benefit on that in writing. It can be electronic, but they have to provide that to the donor, to the purchaser of the ticket or whatnot. Also, other benefits, there's all sorts of kind of charitable bequests and estate planning with tax beneficial elements to it that's available for C3 organizations. As I said earlier, a lot of federal, state, and local government grants and private foundation grants are limited to C3s. And as we've already talked about, no private inurement. And if you engage in private inurement, excess benefit transactions, you can be subject to intermediate sanctions. The recipients can, as well as those who approve it, and no impermissible private benefit. Other limitations, and this is important, and this is one of the greatest kind of myths or misnomers that I've heard over the years. A lot of people, who don't spend a lot of time in this area, believe that 501c3s are not allowed to lobby. That is absolutely not true. 501c3s are allowed to lobby. They just cannot engage in substantial lobbying. Or if they do, they risk losing their tax-exempt status. Now, there are actually two different definitions of lobbying for 501c3 organizations. Since, I think it's 1976, there's been a section of the tax code called 501H. Well, the actual rules are in a different section, but 501H is the section that refers to the 501c3 making an election to be governed by the special set of lobbying rules. And it's basically a much more beneficial set of lobbying rules. Unless you're planning to engage in more than $1 million a year in legislative lobbying, assuming you're not, it should be a no-brainer to make the 501H election. And you can always revoke it at any point later. You file this simple half-page form with the IRS. That means you are electing to be governed by the rules that are contained in Code Section 4911, which is where all this stuff is codified. And the IRS also has really detailed regulations about this. If you're interested, I have a terrific article that I wrote a long time ago, but the rules haven't changed in this area, about the rules for the lobbying rules for 501c3 organizations that make the 501H election. For instance, the rules make clear that lobbying is measured only by your expenses, so what you're actually spending, staff time, outside lobbyists, travel expenses, things like that, but it's not based on, say, volunteer time spent lobbying. Also, it makes clear that lobbying means solely legislative lobbying at the federal, state, and local levels, like trying to influence legislation in Congress or state legislature or city council. It does not include regulatory or administrative or executive branch lobbying. That's really important, because there are some 501c3 organizations that do a lot of lobbying and advocacy and the regulatory and administrative side, but not much on the legislative side. And none of that counts as lobbying. There are also all sorts of exceptions. If you provide information, like technical information, to a committee of Congress upon written request, that's not going to be considered lobbying, and a whole bunch of other exceptions and exclusions from the definition of lobbying. So take a look at that. Another important benefit is that if you exceed, and so for 501c3s that make the lobbying election, you're basically limited. It's a formula, but it's essentially you're limited to about 20% of your total budget can be spent on lobbying, up to a global cap of $1 million. And that cap has been in the code forever. I don't know if it's ever going to change. So for really large organizations, that might not work. Or for an organization that percentage-wise is, wants to spend more than 20% of its budget, the 501H election may not work. But there are alternatives, which I'll talk about in a second. But for everyone else, you really should strongly consider making the 501H election. For those that don't, by default, you're going to be governed by what's called the no substantial part test. And there's no real clarity even on what the definition of lobbying means there. Does it count volunteer time or not? No one really knows, and the IRS has never really said. So it just makes it a much more dangerous and risky test to be governed by. And if you ever get to a point, and this is very common, and there are hundreds of examples of 501c3s they want to engage in more lobbying than they could do in the C3. So what they do is they create a controlled affiliate that's a 501c4. Again, there's some rules about corporate separateness and somewhat different boards and things like that, but you can have everyone on a common payroll as long as they're tracking their time, and the C3 is not at all subsidizing the C4. But if you create that affiliated C4, the C4 can then engage in unlimited lobbying. Has to be funded independently, but can be unlimited lobbying. And it can also engage in political campaign activity. So let me talk about that next. So C3s are prohibited from engaging in any political campaign activity. But keep in mind, this is very different than lobbying. Lobbying, under Section 4911, lobbying means influencing legislation. Political campaign activity is supporting or opposing candidates for public office, whether it's endorsements, whether it's campaigning, whether it's making campaign contributions, if it's allowed under federal or state election law for a corporation to do that. In most cases, it's not. Some cases, it is. But regardless, no political campaign activities at all for C3s. Even technically a small amount could risk losing the tax-exempt status of the C3 organization. And I referred to here, this would even include things like I do a lot of board trainings for nonprofits. And one of the things that I tell, particularly C3s that have kind of board members that are very politically active, don't at all wear, your logo gear from the C3 organization when you're out at a political campaign activity, and don't use, an email that might have, the C3's, logo on it or anything else like that. Volunteer leaders of a C3 can engage in political campaign activity on their own, but we want to make sure it doesn't at all get attributed back to the C3 organization. But a C4 and a C6 can engage in political campaign activities as long as it's not more than half of their overall activity. Taxation of unrelated business income, I'm going to talk more about that, but those are the same rules that are for all tax-exempt organizations. And then I referred earlier to the potential for state and local sales and use tax and real property tax exemption. And if a C3 does have a state sales tax exemption certificate, which is usually how that's done, it only relates, like I said, to the sales tax on purchases, not to the collection remittance on sales tax on sales. Now, again, this is a whole other area, very complex. I'm not going to get into it except to flag for you that all C3 organizations are subdivided into public charities and private foundations. Private foundation status is the default status unless the organization can prove that it meets one of 4 different public support tests. And these primarily focus on whether there are multiple different donors or funders, or if there's just 1 or 2 principal funders, like a corporation that creates and funds its own private foundation, which are common in large corporations, or a family that creates its own family foundation, or even a wealthy individual that creates his or her own private foundation, where there's just really one funder, one family, one corporation. To be a public charity, you have to prove that you get your money from lots of different sources. It is a more beneficial status to be a public charity. It's more advantageous and less restrictive. And the reason for that is that the tax code presumes that a private foundation, since it's being funded just by one entity or family or individual, there's more risk of utilizing that C3, that private foundation, to benefit that corporation, individual, or family, and therefore there's a lot more limitations and restrictions and prohibitions to make sure that doesn't occur. Just briefly on private foundations, in case you're wondering, I'm actually going to have to pick up the pace here. So some of the restrictions on private foundations, there's a federal excise tax on net investment income of most private foundations. Some other restrictions, there's restrictions on self-dealing. So for instance, like the private foundation can't lease office space from, the family or the corporation that's providing funding for it. There are also, for most private foundations, you have to distribute 5% of the fair market value of your assets each year. You have to give it away, in grants or whatnot. Limits on holdings in private businesses, etc. Violations of these restrictions and requirements can give rise to taxes and penalties against the foundation, and sometimes against its managers, substantial contributors, and certain related persons. And there is a form that you're supposed to file to report instances of self-dealing. Okay, 501c6 organizations. C6s are trade and professional associations and chambers of commerce. The basic idea is that these organizations are formed to promote, further, and advance the industry or profession that's represented by the association or the Chamber of Commerce. It's also an exemption from paying federal and state corporate income tax and net income. Contributions to C6s are not deductible as charitable contributions, same for C4s. But for C6s, because they're usually paid by businesses or professionals who they're paying, for instance, membership dues or conference registration fees or purchasing publications from a C6 organization to further their business or their industry, their profession. Generally, they will be deductible as business expenses to the payer, but not as charitable contributions. And then they're subject to a prohibition on private inurement, which I've already talked about. Further, political campaign activities, and this is the same for C4s, are permitted as long as it's less than half of the organization's overall activities. And again, this is political campaign activities supporting or opposing candidates for office, and distinguish that from lobbying. Also subject to unrelated business income. You can earn unrelated business income as long as it remains insubstantial. Most experts believe that generally means that your total gross unrelated business income needs to be less than about 20% of your total gross income for the year. If you do have unrelated business income, the net income after directly connected expenses is taxed at that current flat 21% corporate income tax rate. The most common form of unrelated business income by far is advertising income. And then there are numerous exceptions to unrelated business income, which I'm going to talk about in a minute, such as royalties, corporate sponsorships, convention and trade show income, investment income, certain capital gains income, certain non-debt financed rent. There's something called a volunteer labor exception. The labor of the activity is conducted by unpaid volunteers, and the sale of donated goods, which is essentially the goodwill example. Now, 501c6 organizations uniquely are subject to this law that was passed by Congress in, I think, 1993 in created Code Section 162E, which requires C6 associations to track their in-house and outside lobbying time and expenses, and then report to their members each year the percentage of their membership dues that are not tax deductible as a business expense as a result of the lobbying, or alternatively pay a proxy tax on those lobbying expenses. And this is all reportable on the Form 990. All right, now we're going to talk about UBIT for about 15 minutes, and then we're going to open it up for questions, and I see we have some already. So again, I've given entire webinars and lectures on UBIT alone. It's an interesting and complex area. There's a lot of precedent in this area, statutes, regulations, and certainly a lot of cases and rulings over the years, court cases, IRS rulings, revenue rulings, revenue procedures, private letter rulings, technical advice memoranda, etc. But really, this all came about back in the kind of early and mid 50s. Well, it started before the mid 50s. I mean, before 1950, when there was a pasta company, a CF Mueller company in New York City, that was purchased by a 501c3 New York University Law School, purchased the pasta manufacturing company. And they said all profits from the company are going to be dedicated strictly to the law school and its tax-exempt purposes. They were challenged by the IRS. The Third Circuit Court of Appeals reversed the U.S. tax court decision that it held that the law school was no longer organized and operated exclusively for charitable purposes. And the Third Circuit relied on what was then called the use of funds test, meaning as long as the tax-exempt organization used the funds in furtherance of its mission, then it was fine and it wouldn't be taxed on that income and it wouldn't put its tax-exempt status at risk. Well, Congress didn't like that result. There was a lot of complaints from for-profit companies talking about unfair competition. So in 1950, Congress enacted the unrelated business income tax statute, which eliminated the use of funds test and imposed what is now the current UBIT regime, which has really been in place with a few exceptions since 1951. This is the definition. Unrelated trade or business means trade or business, the conduct of which is not substantially related to the exercise or performance by the organization of its charitable, educational, or other purpose or function constituting the basis for its exemption under 501. And this applies to all tax-exempt organizations, not just C3s. So unrelated business income has a three-part test. And in order for income to be taxable as unrelated business income, the underlying activity that generates the income has to meet three prongs of a test. It has to be a trade or business, which basically means you're carrying on the activity with a profit motive. that's regularly carried on, like a one-off activity is not going to be regularly carried on, but if you're doing it over and over on an annual or whatever basis, it's generally going to be regularly carried on. And the activity is not substantially related to furthering the organization's tax-exempt purposes. If all three prongs exist, then you may have unrelated business income. And I say may because there's a number of exceptions we'll get to in a minute. Like I said earlier, you can earn unrelated business income, you pay tax on the net income, but if your total unrelated business income is more than insubstantial, you can jeopardize an organization's tax-exempt status. But then, as I said earlier, you have options like dumping it into a taxable subsidiary to protect the parent tax-exempt organization's exempt status. And even if all three prongs of the test are satisfied, there are numerous specific exceptions and exclusions from UBI that may apply. What income is usually treated as UBI? Well, advertising income is the most common. I'm not going to get into it here, but there was a 1986 U.S. Supreme Court decision, U.S. versus American College of Physicians, where the college was trying to make the case that the advertising in its medical journal should not be subject to unrelated business income taxes. It was providing helpful information about medical devices and products to doctors, to physicians. And the court said, no, we don't agree. They did create this theoretical, very narrow exception that if the ads were strictly tied and linked to the editorial content of the magazine, that might be able to qualify. But that's rarely the case because it doesn't really work from a business perspective in most cases. Other maybe less common, but common forms of unrelated business income: rental income received from debt finance property where you have a mortgage on it, and payments from certain controlled entities. We have a majority control over a taxable or tax-exempt subsidiary or affiliate like rents or royalties that's subject to tax, unrelated business income tax. However, the good news is there's a number of exclusions from UBI. Here are some of them. There are more. Qualified corporate sponsorship income, and I'm going to talk about a few of these very briefly. Qualified corporate sponsorship income, royalty income, qualified convention and trade show income, interest, dividends, annuities, and certain capital gains, certain non-debt finance rental income from real property, volunteer labor, where 85% or more of the labor of the activity is conducted by unpaid volunteers, sale of donated goods, certain research income, certain bingo games, and renting mailing lists to other charitable organizations. A few miscellaneous things here. There is a $1,000 corporate income tax deduction for UBIT. UBIT taxed at the flat 21% corporate income tax rate. Before the tax code changes from a few years ago, it was the graduated corporate income tax rates that for-profit companies paid. So the UBIT rate was much higher. That's a benefit to tax-exempt entities. You can take a deduction for directly connected expenses incurred to generate the UBI. Net operating losses are generally permitted, just like they are for-profit taxable entities, unless they recur for a number of years, which suggests that you don't have a profit motive and therefore you should not be able to take a tax deduction. Again, the IRS got really aggressive on this a few years ago, but something just to keep in mind. This is another change that the IRS pushed for and Congress enacted in the tax bill from a few years ago, which is that tax-exempt organizations can no longer offset losses from one unrelated business activity against gains from another. So you used to be able to take if you have multiple different unrelated business activities and you had some profits in one and losses in another in a given year, you would aggregate it all together like a for-profit business would. And then whatever the total net income is, you're only subject to tax on that amount. So losses from one activity could help offset gains from another. You can no longer do that. It's like some people call it the silo rule. Like each unrelated business activity, you just compare the income and the directly connected expenses for that, and you determine what the tax liability is, and then for the next one, and then the next one. Which is a planning opportunity, by the way, if you do have a situation where you have multiple unrelated business activities and you do want to, use losses from them to offset gains of another. It would be something to consider to put all of those activities into a taxable subsidiary, because then you're no longer dealing with UBIT, you're just dealing with a for-profit corporation that's subject to tax, and then you can do that offset. And then, like for-profit corporations, you have to make quarterly estimated payments at the federal and state levels for UBIT, or you get subject to penalties. Public disclosure requirements. This is really, really important, and it's one of the unique features of tax-exempt organizations that a lot of exempt organizations don't like, but it's been this way for a long time, and actually, with kind of the advances and whatnot in technology, it's become so much easier to get access to the Form 990s that are filed by tax-exempt organizations than it ever was in the past. But in addition to just going to these various databases where you can pull them up, although they're generally going to be, like you file your return, it's due 5.5 months after the close of your fiscal year, but you can get up to an automatic 6-month extension. So by the time it actually gets into the IRS, and then by the time it gets on to GuideStar and other databases, you're generally looking at about at least a 2-year lag time. So if you went on like GuideStar now to look at a number of Form 990s of tax-exempt organizations, most of them, the most recent one will be the 2019 one. All depends on when their fiscal year is and whatnot. So there's a little bit of a delay. However, all tax-exempt organizations must make their IRS Form 990s available for public inspection. This was a law that Congress passed probably 15 years ago, maybe 20 years ago. And basically, anyone who wants to see your most recently filed Form 990, they actually can ask for the last 3 Form 990s. They just go to you, and they can show up in person if you have in-person offices, and you have to have it available for public inspection. They can ask for copies. You're allowed to charge a copying charge. A lot of this is antiquated stuff, because now most organizations just provide it all electronically, like in a PDF. But if someone asks for it, no matter what the reason, or even if they have no reason at all, you have to provide it to them. And it's not just the Form 990s. It's the last 3 filed Form 990s, but it's also your IRS determination letter, and it's your IRS tax exemption application, that Form 1023 or 1024 that I talked about before, and all attachments to that form, and any correspondence back and forth to the IRS. So look, the reality in the nonprofit world, at least for a lot of the larger organizations that I represent, is that there's a lot of organizations on the other side of their issues, whether it's a trade association, whether it's a social welfare organization under C4, whether it's a conservation group. There's always folks on the other side who want to dig and want to find any kind of dirt on the organization or anything they can use against the organization, or examples of non-compliance. So keep in mind, all of this stuff is very much subject to public disclosure. The one exception is that for 501c3 organizations, there's something called Schedule B to the Form 990, which includes a list of major contributors, donors. That you have to file with the IRS, but that's not subject to public inspection. That doesn't show up on GuideStar or other places, and if someone asks you for a copy, you don't have to provide that. But everything else you do have to provide, and there are some significant financial penalties if you don't provide that stuff. And that's what it talks about here, what these penalties are. I am running out of time, so I'm just going to kind of skim through this to show you what's here. I think this may actually be my last slide. So 501c3 organizations, like I said earlier, you're eligible to receive tax-deductible charitable contributions, as well as certain 501c19 veterans organizations. However, no charitable deduction is permitted for any contribution of $250 or more unless the donor has contemporaneous written substantiation from the charity, like a receipt or a thank you letter or email or something. And then in cases where the charity has provided goods or services to the donor in exchange for making the contribution, like the fundraising dinner or whatnot, or some other gift or something like that, of anything less than really de minimis value, and there's some detailed definitions of what that means, then there has to be a written acknowledgement to the donor that includes a good faith estimate of the value of goods or services that are provided. So that's what the donor has to have in order to take a charitable tax deduction. And as you may know, with the increase in the standard deduction that occurred in the tax bill that passed a few years ago, I think it was 2017, it made it less advantageous or less necessary for a lot of taxpayers to itemize their tax returns, to itemize their deductions, because the standard deduction increased so much. But you can only take a charitable tax deduction. There was a few exceptions in some bills that were passed by Congress during the pandemic in connection with kind of a COVID-related relief. But other than that, you can only take a charitable tax deduction if you itemize your return. So a lot of taxpayers, especially individuals, for smaller stuff, they don't really care about the charitable tax deduction, but some certainly do. And for bigger contributions from individuals or corporations, they certainly do. But anyway, I just wanted to make that point. I talked about earlier the quid pro quo, that if the contribution is in excess of $75 and they get something in return, the charity has to provide the substantiation of the fair market value of that contribution. And that is the end. And before I turn it open for questions, I just want to say on things like the unrelated business income tax stuff, and I obviously this is an overview of all of these issues, so I couldn't get into it much. But if you're interested in learning more about those issues, on our firm's website that you see here, well, I should actually put the website on. It's tenenbaumlegal.com. It's in the email address. But we have a ton of resources on there on all sorts of different issues. I have dozens of articles that I've written on kind of nonprofit legal and tax issues, and many on unrelated business income tax issues. Articles. In fact, there's a recent one I wrote, kind of a very comprehensive article about all different aspects of unrelated business income tax. So if you want to learn more and see more about that, take a look there. And then if you're interested about any other aspects of nonprofit legal issues, there's a ton of articles and PowerPoint presentations on lots of different topics. And then one of the silver linings of the pandemic has been, first off, the use of video webinars like this one, which were not nearly as common before the pandemic, but also the use of recording those videos, those webinars. I've personally done probably easily over 125 video webinars in the last 22 months since we started the firm. And we have recordings of many of those webinars on all different sorts of legal topics, COVID-related legal topics for nonprofits, and many others that are on our site. So if you are interested in learning more, I'm a big believer in kind of sharing all that stuff and pushing it out there. And if you ever have any questions, feel free to reach out. But one last thing before I open it up for questions, when you're advising nonprofits as a nonprofit specialist, like I am, obviously one thing you can do is attend webinars like this and learn more about it and read articles and presentations and watch recorded webinars and things like that. But it's also important for you to be able to kind of understand the basics and be able to spot the red flags. Obviously, there's sometimes you're going to have to bring in a specialist to help. But a lot of times you're providing, say, pro bono legal services, and the organization might not have the resources to be able to, to afford paying for legal counsel to do this. And so you're going to have to kind of do your best to play nonprofit lawyer and advise them on all of the stuff. But there are more resources out there on these issues than they've ever been. When I started practicing law 26 years ago, I tried to kind of read everything I could to learn about this stuff. And, most of what I had to read was in print in terms of books and articles and things like that. So much is so much easier to get online these days. So there's lots of good stuff out there. And feel free to reach out to me if you ever have questions. Speaking of questions, wow, there are a good amount here. This is a good question. I get this a lot. Are the public disclosure requirements related to financial statements? So the short answer to that is no. Certainly not from the IRS. There's no Internal Revenue Code-based, IRS-based requirements related to disclosing financial statements. Now, going back to the state nonprofit corporate statutes, wherever your nonprofit is incorporated, remember that's what you're going to be governed by in terms of the nonprofit corporation statute. Most of those statutes have a provision that says that the nonprofit is required to provide access to kind of the books and records of the organization to members, if it's a membership organization, and certainly to board members. But most of them do not say for a 501c3 organization that you have to provide access to the books and records to like a member of the general public who might come and ask. And so that's going to be the majority of the cases that you guys are dealing with. There's not going to be any right of inspection for financial statements or otherwise. Now, do some nonprofits post financial statements on their website? Yes, but I'd say that's not the norm. It's not the norm at all. But again, it's a business decision. Obviously, there's a lot of politics involved. I will say that the financial statements are what are used by the CPAs to create the Form 990. So while things are presented differently and there is additional information in the financial statements that's not in the 990, and don't ask me specifically what that is because I'm not an accountant, but still, it's not going to be a state secret, about what your total income and expenses and assets and liabilities are, because it's going to be reflected in some form, at least in the Form 990. Can a nonprofit corporation simply revoke the tax-exempt status with the IRS without dissolving the business at the state level? So this is a great question. We deal with this all the time. So that the thing is, for a 501c3 organization, one of the requirements is that you have to have a provision in your articles of incorporation and or bylaws, at least in the articles, that says that whatever assets a C3 has have to be permanently dedicated for 501c3 purposes. So if you dissolve, for instance, those assets have to go to another 501c3 or to a government agent, to a governmental body. So we have had situations over the years where an organization is a C3, it's accumulated a lot of assets for a variety of different reasons. It realizes it doesn't want to or can't or even can't qualify to be a 501c3 organization. It can't just convert to another category like a C6 or a C4. That's impossible. You just can't do it. So, and there's no way to just go to the IRS and say, we're giving up our tax-exempt status and we're just going to become a taxable entity. And that can't happen because you can grant the assets away to another C3 and then dissolve, but otherwise the assets have to be permanently dedicated for C3 purposes. If it's another category of tax-exempt entity like a C6 or C4, though, there's a lot more options on how to get those assets into another entity. And the other kind of related part of this, and this happens a lot, sometimes entities just run their useful life and you want to dissolve them. If you want to dissolve an entity, you first have to get rid of all the assets, satisfy all liabilities, then you file articles of dissolution with whatever state you're incorporated in, and then you file your Form 990 with the IRS, provide a copy of that, the certificate of dissolution, and let them know that's your final Form 990. But again, the assets have to be kind of granted away first. Are there limitations on what a tax-exempt organization can do for or contribute to a for-profit subsidiary? It's a great question. So one of the articles that's on our website is all about how to operate taxable subsidiaries of tax-exempt organizations. And one of the key things there is that tax-exempt organization, regardless of the category, C4, C3, C6, it cannot subsidize the taxable subsidiary in any way. And that's because what the subsidiary does as a taxable entity, it's not consistent with the tax-exempt parent status. And so, for instance, if all the staff are going to be on the exempt organization's payroll, they can provide management services, staffing services to the taxable sub, but the taxable sub has to reimburse, at cost or fair market value for those services. Now, the one thing that you can do is that when you first form the organization, you're going to put seed money in capital to form the entity in exchange for the stock that you're going to get, or the ownership stake, whether it's a C Corp or an LLC. And so that's it's definitely one bite at the apple when you first form it. I always tell clients, if you're going to do this, put as much money as you can in exchange for the stock. Now, theoretically, you could do that again and maybe again and get more stock. But if you're the sole shareholder, the IRS could well challenge that, saying, that doesn't really mean anything. You're the sole shareholder. So you got 100 shares the first time, you get another 100 shares the second time you make a capital contribution. That's kind of meaningless. So bottom line is the tax-exempt organization cannot subsidize the taxable sub. And this also relates to like C3 and C6 relationships and C3, C4 relationships. In both of those instances, the C6 or the C4 is allowed to subsidize the C3 because that's within the scope of what the C6 and C4 can do, but not the other way around. So that's why I said earlier, like if a C3, creates a related advocacy arm as a C4 to engage in more lobbying and political campaign activity and whatnot, that C4 has to have completely independent funding, and it can't not at all be subsidized by the C3. How does a nonprofit permissibly fund its formation, organizational, and initial legal and other third-party expenses before it's qualified tax exempt? I'm not sure I completely understand the question, but I will say that when you first form an entity, it's formed from the moment you file articles of incorporation with the state, and those are accepted. You get your certificate of incorporation. That's the date of birth of the entity. Then you go online, you get an EIN number from the IRS. That's like the corporate social security number. From that moment on, you can take those two things, go to a bank. Usually the bank requires some resolution authorizing the signers. But open a bank account. You can start bringing in money. You can start spending money. You use that money to hire lawyers, for instance, to prepare a tax exemption application that you're going to file with the IRS. What you just cannot do for C3s or for would-be C3s, you cannot tell people that their contributions are definitively tax deductible as charitable contributions, but you can tell them that you are in the process, that you're in the process of preparing, or you filed your tax exemption application, you expect it'll be approved, and when it is approved, it's retroactive back to the date of incorporation. So even if someone did make like a contribution, the day after you were formed, even if the approval from the IRS, and they're taking a bit longer, although we've actually been getting them approved quicker than they were in the last 12 months, but still they're taking anywhere from maybe 6 to 9 months to get approved. And it all depends on how good of an application you prepare and how clean it is and whether there's any red flag issues. There's a lot of factors there, but once it's approved and it's retroactive back to the date of incorporation, then someone could still take a tax deduction for that contribution that was made after the formation date. Does it violate the private benefit doctrine if a C3 provides continuing education to a group of doctors or lawyers? Generally, no, so long as it depends on who the group is. So one of the permissible purposes of a C3 is education. So C3 is allowed to provide education. But no matter what the C3 is doing, whether it's education, whether it's my example earlier from one of my clients where they wanted to form a C3 just to benefit a particular for-profit company, if the group is too small, let's say you were just a group of doctors in a particular medical practice, or just a group of lawyers in a single law firm, even a big law firm, it's still, that's not going to be a big enough charitable class to qualify. It's too small. That's why, like, sometimes you see, I've seen, like, unfortunately, a lot of like natural disasters and things like that. And a lot of people want to form 501c3 to raise money to benefit a particular, family or group of families or something like that. One of the things the IRS says is that you got to make sure the charitable class is big enough to qualify. So that's something really important to focus on. This is a good question. How are nonprofits different than crowdfunding? So it's not that it's different. Sometimes crowdfunding is used to drive contributions to nonprofit tax-exempt organizations. And you're all familiar with GoFundMe and all different crowdfunding platforms that can be utilized. But in many cases, crowdfunding is used to raise money for, like in my example I just gave you, a particular individual or a family or someone that needs help or needs raising money for surgery or for medical care or whatever else the case might be. And in those situations, the donors are not able to take a charitable tax deduction because the money's not going to a charity. But if the GoFundMe says the money is going to go into a charity, and then the charity is going to have discretion to decide how it's going to carry out its charitable mission and use that money to fund things, that could give people a charitable tax deduction. The one thing to keep in mind, it's the final thing I have time to say, is that if you give money to a C3 and you earmark it for a particular individual or family or even small group, that's not going to be eligible for a charitable tax deduction because it's as if you're giving it to that individual directly. It's called the conduit rule, and therefore that's not going to qualify for for a charitable tax deduction, because you're just like if no matter how worthy the cause may be, if you give money to a particular individual or family, you can't take a charitable tax deduction. On the other hand, if you give it to a charity that's creating a general fund to use and help support all victims of hurricane, pick your hurricane or whatever the other natural disaster might be, and then it's up to the charity to decide how to use those resources, that would be eligible for a charitable contribution. Could you use a membership corporation as a way to have a foreign nonprofit control a U.S.-based affiliate? Yeah, absolutely. And I mean, well, let me put it the other way around. We utilize it often with foreign affiliates. I work with a lot of international NGOs that are, say, based in the U.S., and we create different, foreign affiliates. And we'll often, if we can, a lot of this is subject to local laws in different countries, but we'll create it so that the foreign entity has a sole member, and that sole member is the U.S. international NGO. In terms of the other way around is a more complex answer that's kind of beyond the scope of this discussion. And I think I have maybe 1.5 minutes left. Let's see if there's one other good question we can get to here. Talk about ballot initiatives and referenda. And I think that the question is, first off, that's not going to be considered political campaign activity because it's not supporting or opposing candidates for public office. And with an example, an exception, like for instance, the recent move to try to recall Governor Newsom in California, that would certainly be considered political campaign activity that a C3 would not be able to support. But a lot of other times, when it's just a ballot initiative, it can sometimes be considered lobbying. But there's an important, I didn't mention it earlier because it's kind of beyond the scope of this, the distinction between direct lobbying and grassroots lobbying. Something just to keep in mind, that under that 501H election, I said that C3s can generally spend up to 20% of their total budget on lobbying each year with a global cap of $1 million. But grassroots lobbying is limited to 25% of that total. And that's when it's the general public to go, say, contact their members of Congress or whatnot. And a lot of C3s do spend money on that, but that's a much smaller sublimit. So you really have to keep that in mind and focus on that. But that question does point out that you got to drill into because not every referenda or ballot initiative or judicial nominee appointment, not everything is going to be considered lobbying. Sometimes it will be, sometimes it won't. You got the devil's in the details. So I want to thank everyone for your time and attention today. We are out of time, but I hope this was helpful. Feel free to reach out if you have any questions, and hope you enjoy the rest of your day.
Thank you so much for sharing your expertise with us. On behalf of the American Bar Association, ABA-CLE, we want to thank you for participating in this program. To learn more about the sponsors, you can visit the ABA website at www.americanbar.org. Thank you. Please click on the evaluation link. We do value your feedback.